Hello everyone, this is Paul once again from APNacademy. So in this video, we're going to be looking at the types of market movements. And now recall that whatever we are doing or whatever we are learning about has to be leading you to making a decision, either to buy or to sell. But before you make that decision, you need to understand the type of movement the price is making. Now, these are the types of movements that we're going to be looking at today. And every market, no matter the type of market you're trading, whether you're trading stock market, whether you're trading forex market, whether commodities, cryptos, synthetic indices, and the rest, all of them make these types of movements. And the first thing you have to do is to identify the direction where the market is doing. That's the first thing you always have to do as a trader, the direction. And what helps you to determine the direction? These are the types of market movements, right? So we're going to look at each type of market movement and its behavior or its characteristics that we're going to be discussing, right? So the very first type of market movement is the uptrend, when the market is moving upwards, right? Now, what we call an uptrend or an upwards movement is, in this situation here, a trader is going to be thinking of the market moving upwards, just like the name suggests, right? Upwards or an uptrend. And let's first define what a trend means. A trend means that what everyone is looking for at that particular time, or what everyone is interested in doing at a particular time, in a layman's language. But also in the market, we have what we call a trend. A trend is the direction or the movement the market is offering at that particular time, right? Or it's the direction the price has chosen to take, or it's the direction the market is moving towards, because of either supply and demand forces, either of the two, right? So also in the market, we have trends, and you need to identify where is the market trending, where is the price trending, right? So those are the movements we're looking at today. And the first one we're talking about is the uptrend, or what we call the upwards movement, right? Now, let's look at the behaviors of this uptrend. The first thing is it has to be making higher. Let me just write it here, higher. That's be making higher highs, right? That's the first one. And then the second one is after making a higher high. Remember, the market does not move in a straight line, right? After making a higher high, the market has to make what we call a higher low. A higher low. So when the market goes up, it has to come back down to make a low, because remember, we just mentioned that they move in a straight line. Now, after this, shall we know that the market is still continuing in an uptrend or is still going up? It has to create a new high. And that new high is called a higher high. Let me just abbreviate it as HH, right? And this one will be abbreviated as H low, right? So in an uptrend, or what we call an upwards movement, the market should be creating or printing for you higher highs and higher lows to show you that it is going up, just like the name is suggesting, higher. We are going higher. So the moment you start spotting higher highs in the market or the price is moving upwards, right? So this is the very first type of market movement that you have to be able to identify before even you do anything in the market. You have to identify what direction are we in, what movement is the market making, so that you can join it, right? So let's go to the second one. We see the second one. The second one is what we call the downtrend. It's just the opposite of the uptrend. So what's the behavior or the characteristic of the downtrend? One, I hope you can guess by now, we are making what we call lower lows, right? I will abbreviate it as LL. Then the second one is we are making lower highs. I'll abbreviate it as LH, right? Now, when you see the market is making lower lows, and how do lower lows look like? The market will first go down. It will create this low. Let's say it has come down, right? It turns from here and then it goes up, right? But fails to surpass or to go beyond this high here that it had first created. So when it turns from here and breaks this previous turning point here, this is what we call a lower low. When the market breaks and turns from here, it's what we call a lower low. So in a downtrend, or what we call a downward movement, the market is creating a series of lower lows and what we call lower highs. This is a lower high because it is lower than the previous high the market had created. So even if the market comes and again stops here, In a downtrend, we're expecting it to continue printing lower lows, low. This is a high, this is a low. When it creates a lower low, we expect to print another lower high, right? A high that is lower than this previous one. Are we together? We're going to learn this in when identifying areas of value. You're going to see that these lower lows and lower highs, or higher highs and higher lows, are very important when identifying areas of value. Most traders tend to ignore this, right? But this actually gives you the basis, or it gives a starting point on where you're going to take your trades from, or where you're going to pick an interest in a pair or a certain security, whether you're trading stocks, cryptocurrencies, or whatever you want to trade, right? When you identify turning points, or you identify lower lows and higher highs, or higher lows or lower highs, it gives you a starting point. It gives you interest in something, in that security. The moment you cannot identify that, it's going to be hard for you, right? So this is how a downtrend looks like. Of course, we're going to be going to the chart just shortly. Then let's go to the third type of market movement. The third type is what someone can call a consolidating market, or someone can call a ranging market, or someone can call a sideways market. Now, what do we mean by it? Something that is consolidating has no direction. It's just almost in one place, right? Or something that is ranging. It's just in a particular range, right? A range, you know that it's like from a certain point to a certain point. So it means that the market is just within here, right? Or it's moving sideways. Someone can call it sideways, right? Now, a consolidating market or a ranging market has the following characteristics. One, we are making equal highs. We are making equal highs. Then two, we are making equal lows. Let me just write it here, equal lows, right? It doesn't mean that it's going to come to the same place, up, down like this. No, it's moving while creating structures, while creating turning points, but not crossing that particular range or that particular area in which it is moving, right? And what do I mean by that? What I mean by that is this. Let's say the market creates a turning point, this turning point, let's say it was coming down. Then it creates, let's say, a turning point here, and then drops down, right? And creates this turning point here like this. Now on the market, this is a high, this is a low. Now when the price goes up, reaches here, fails to cross here, and creates a structure to push it down, it will come down. Now when it reaches here also, creates a structure making it fail to cross this low, pushes it back up. When it reaches here again, does the same thing. Now, what do we see here? We are seeing the market is creating, these are highs, of course, right? But the market is creating equal highs. These are equal highs because they are the same level. Are we together? These are also equal lows. The market is creating what we call equal lows. Now, whenever you identify this, it's nice to trade, but you need to have experience and be able to identify that the market is in a ranging market. It's in a ranging mode, right? So these are the types of market movements that a trader needs to understand and be able to identify. Are we together? The moment you cannot identify this, you're going to fail to know where you're going to take trades from, because these, knowing the movement you're in and being able to identify the turning points, right, gives you the area in which you're going to be picking interest in a particular security. Most of the traders are making mistakes of not knowing where they are in the market, right? Or they're making a mistake of just joining a trade without knowing where am I joining from. And how can you be helped upon that issue is by first learning or first knowing how to identify the movement. The moment you identify a movement, you know that, oh, I've just created a lower low. After a lower low, what needs to happen? We need to retest. We need to retest the previous lower low, creating a lower high. Then I'll know that I would like to enter the market from here, or I'll pick interest in the market from here. Of course, before entering a market or entering a trade, there are certain things that you have to consider, right? So these are the types of movement that the market makes. No matter what type of market you're trading, no matter what type of security you're trading, it will always create this, because the market is only doing two things. The market is either going to provide an opportunity to buy, or it's going to provide an opportunity to sell, no matter the type of movement it's making, whether it's in a ranging market or downtrend or uptrend. it's going to always create for you opportunity to do these two things. There is nothing else. There is no third thing the market can give you to do. So having looked at the types of markets, let's first do a recap before we can go to the charts. Let's first do a recap. Now, we first talked about the uptrend. The uptrend. What did we say about the uptrend? We said the uptrend is giving us an opportunity for a market to move up. And when we expect the market to move up, what we want to do, we want to take our buys. So what are the behaviors or characteristics of that uptrend? One, we said it's creating higher highs. And then two, it's creating higher lows, right? So how do the higher highs and higher lows come about? The market will first give you a high. When it gives a high and turns from here and comes and turns from here, not taking out this previous turning point, right? It makes this one a high, right? And then makes this one a higher low. Why is it a higher low? Because it is higher than this previous turning point, the previous low that the market started moving up from, right? So this becomes a high, this becomes a higher low. Now in an uptrend, we have just said that we expect the market to print a higher high. Why is this turning point here called a higher high? Because this turning point when the market turns to come back down is higher than this previous one here, right? That's why we call it a higher high. And why do we, when the market turns from here again to continue up, why do we call this, why do we call it a higher low? Because it is higher than this previous low that the market has created. So in an uptrend, we just keep creating higher highs and higher lows, higher highs and higher lows, right? The moment you're able to identify this, it will be easy. And how do you identify it? Just turning points, right? Remember, we just have a video amongst our videos of the types of charts. You can use the line chart in case, well, I'm going to show you how to identify the lower lows and higher highs or lower highs on the chart just in a few seconds. But if it's going to be difficult for you, I'm going to show you all the possible ways and on the different charts. But if it's hard, you can always use a line chart. Line chart is very important and it's easy to spot even for someone who's just beginning, right? So this is the behavior of uptrend. Now let's go to the second one. We talked about downtrend, right? Now downtrend, what is it printing? Downtrend one, it's printing for us lower lows, and the second one is printing what? It's printing for us lower highs. How does it do that? The market first creates for you a low here. When it creates this low and turns to go up here and reaches a certain point and turns to come back down, this is what we call a lower high. Why? Because it's lower than the previous high where it started pushing the market down from. Now, when the market breaks down below here, we expect it to come back to retest the point it has broken. When this turning point that it gave you here, this is what we call a lower low. Now, this lower low here, we expect the market not to go back and retest the previous point that it had broken. Now, in the process of retesting this point here, it's giving what we call a lower high. Now, this is what makes a downtrend. The market keeps printing lower lows, like we've mentioned here, lower lows and lower highs. So the moment the series of lower lows and lower highs changes, it means the market or price is no longer interested in going that direction, right? So this is about downtrend. Then when we go to sideways, we are creating equal highs and equal lows, right? So how do we create equal highs and equal lows? The market, maybe, let's say it's coming from down, creates this high here, right? Then comes down, turns from here, creates this low, right? Then comes to this high, fails to take it out. So it creates an equal high here with this previous high. When it comes down again and fails to take out this previous low, it creates what we call an equal low. So it keeps moving in between here, right? So this is all theory, because even on the charts, the market's not going to move like this, perfectly like this. So let's just go and look at the charts and see how we can identify them on the charts so that it's easier for you, right? So let me just go to my chart right now. Okay, so let's take an example at Euro AUD on my chart here, right? Let's try to identify what we have spoken about, the types of movements. Now, by the look of things, just when you look at this chart, it's obvious to tell that here the market was moving up. But you need to know, you need to be able to identify, I'm using the daily chart, what the higher highs and higher lows can be created in any time frame, right? It can be created in weekly time frame, it can be created in monthly time frame, it can be created in hourly time frame, minute time frame. And each of these time frames has a different purpose, right? You can just look through our videos. We have a video on time frames. One of the key reasons why 95% of the traders are losing money, it's time frames. The moment you understand the use of each time frame, everything will be easy for you. So the reason why I'm using the daily time frame, it's because one, there's less noise, and then two, it gives us the areas of value, the areas of interest. Before even we get to the point of taking a trade, you need to pick an interest in a trade. It's just like before you involve yourself in a venture, you need to have interest in it. Without interest, you can't pick up a venture. So the same applies for a trade. Before you say that I'm going to take this trade, no matter the direction it's taking, you need to first pick interest in it. And what gives you interest? The higher time frames, the monthly, weekly, and daily. Without interest, you cannot take a trade. So now let's try to identify the higher highs and higher lows. So in this case, the market first created this high here, right? Created this high, then it came and created a low here. Now, someone may be asking, what am I basing on to say that the market was creating a high and a low here? I'm looking at the turning points. If you're not able to see the turning points, you can just use line chart. Like I mentioned, you can just go and change your chart to line chart, and you can be considering these turning points. The market turned from here, right? Then when you come down here, the market turned from here. So you can clearly see that this is the same area. And then you can keep using the line chart until you're comfortable with the candles. The market turned from here and also turned from here. You can mark all turning points just for learning purposes for the start. But when you learn, you don't need to mark all this because it will make your chart dirty. Then again, the market came and turned from here, right? The market again came and turned from here. Again, we have a turning point here, right? So when you go back to candles, you'll clearly see that these were turning points. The market came and made the high. Let me just show you here. The market came and made this high, then came and made the higher low, made the high, of course, made a high here, but came and closed here. So this was the closure, made the high, made the low, made the high, made the low, made the high, right? So this is what we call an uptrend, when the market is making higher highs and higher lows. Are you together? Now, what did the market do after? The market after changed the series of movement it was making. Let's just look at what it did after, right? The market after changed the series of movement it was making. The market came and made a low, then made a lower high. This is an indication that the market is tired of continuing. Let me just remove all these drawings so that the chart is a bit clear. The market came, what I'm talking about is this. The market made this high, right? Then came and made a low. If we still continue up, we're supposed to make a higher high. But instead of the market do, it created for you a lower high, right? So this is a communication that the market is tired. When someone is tired, they mean that they're not going to continue. But the next action shows you that they're not able to continue. For example, if someone is an athlete, they're running and they start slowing down, that's an indication that they're tired. But they can still continue running until the finish line, right? But the moment they sit down, it's showing that the person is tired, they can no longer continue running. So it's the same thing here the market has done. The market created a lower high. So this does not indicate that the market cannot continue up. What indicates that is when the market takes out the previous turning point here. When it broke it down, it made a lower low. Remember here, the market first made a lower high, right? So when the market made this lower low and then broke down here, right? This is an indication, a communication to you that I am now starting to make lower lows. How will you confirm that when the market comes and retests this previous lower low that it had broken, this turning point here is what we're calling it, lower low. And when it fails to break it or take it out and turns to sell, especially when it gives you a change of trend here, it means that now we're on a downtrend. For example, you can see that the market made a low, lower high, low, lower high, low, lower high, right? Then it made equal lows here, then again made a lower high, made a lower low, lower high, lower low, right? So this is what we have just spoken about. But like I mentioned, it's not going to be as smooth as we saw in the theory. Most books will show you just like this: higher high, higher low, higher high, higher low. You can clearly see that this is not how it is. Or they will show you lower low, lower high, lower low, lower high, lower low. This is not how smooth the market moves. The market moves like this. This is the reality. And you need to know how to identify the higher highs and higher lows. And how do I identify that? The previous turning points, right? So here, let's just mark our turning points. Let's just mark our turning points using the line chart. In case it's hard for you still in the candle, let me just remove this. So let me just change to line chart. You can use line chart anytime. So let's mark, this is a turning point, right? Then you come again and mark this turning point, right? So let's just check. I'm not going to mark all of them just for purpose of time. Let's go back to candle and you see, let's go back to candles. You can clearly see that the market made this low here. The market made this low here, then made a lower high here, then made a lower low, then made a lower high, then made a low. This is an indication of a downtrend. And if you can clearly see, it made a low, lower high, low, lower high, low, lower high, like that. Low, lower high, low, lower high, low, lower high. This is the movement. You need to be able to identify this. Once you're able to identify this, everything is easy, right? You know where you're going to take it. What is your area of interest? Where is my area of interest? What am I supposed to be there? Depending on the direction, right? If you say you're headed north, you cannot again take a bus that is taking you south, right? Hope we are following. So we have so far looked at uptrend and a downtrend. Now, when the market reached down here, what did the market do? Let me just go back. What did the market do here when it reached down? Right? It created this turning point here, this turning point here, right? If you want, you can use line chart, but I am comfortable with the candles too. But for purpose of learning, you can also go and use line chart. Let's put line chart also. This turning point is what I'm talking about, this one, right? It made this turning point. Then it also had this turning point here. Let me just mark it for you, this one. So let's go back to line to candles. And you can clearly see that the market failed when it came and created this turning point here. It broke down, created this turning point, of course, with a structure, went back up, failed to take out this previous low, right? Then came back down here, failed to take out this low, came back up here, failed to take out the high. What do we mean here? We mean that the market created the low, it came back and created the high, right? So when the market comes down, what do we expect? We expect it to continue down, right? But instead, what did it do? It went up. And when it went up, we expect it to create a high. But instead, what did it do here? It created, what did it do? It created an equal high, right? Equal high because it's at the same level with this previous high, this one here, right? Then again, the market came back down, right? Creating equal lows. Why equal lows? Because it's the same as this low here, this previous lows. Are you seeing? Again, came back up, created these equal highs, right? Of course, it created a false breakout here, which market makers normally use to manipulate traders. But we're going to look at all this. We have a video about breakouts somewhere there. You can just look through our videos. You'll see a video on breakouts and how to identify false breakouts, right? Then gave a false breakout, came back, we tested the equal high and came and created this low here. So this is the third type of market movement that we talked about. And all of them, you need to know which is your area of interest. Where are you picking interest in that security or that particular pair? That's the importance of knowing the type of movement. The type of movement gives you the area of interest or where you are in the market so that you can join that direction. Are we together? So that is it that I wanted to talk about today. I hope you guys picked out some value in this. And if you did, please do not forget to click thumbs up button, or do not forget to subscribe if you're just new to the channel or you just came across the channel. Have a great time.